this week's market update, Donald Trump aims to deliver progress on trade ahead of November's midterm elections. Fed Chair Jay Powell strikes a dovish tone at Jackson Hole, and markets respond to both developments by hitting a new high. This has been a good week for investors, particularly in the US, where the S&P 500 and Nasdaq both hit new records. The resurgence of risk appetite comes as two of the major clouds hanging over the stock market cleared, at least partially: rising interest rates and trade tensions. The first piece of good news came from Jackson Hole in Wyoming, where Jay Powell's speech to the annual gathering of central bankers struck a reassuringly dovish tone. With the Fed on an apparently steady tightening path, Mr. Powell had the opportunity to counter the president's recent grumbling about the Fed's rate hiking bias. He chose not to. Instead, he said the following: "If the strong growth in income and jobs continues, further gradual increases in the target rate will likely be appropriate." Well, that's about as cautious as you could expect a Fed chairman to be in the middle of a rate tightening cycle, with plenty of fiscal stimulus from the Treasury to lean against and a jobs market firing on all cylinders. The market certainly took this as a very dovish speech, and the dollar weakened as Powell spoke. The dollar had strengthened on expectations that interest rates would rise in the US while they remain pegged to the floor elsewhere in the world. So, a more dovish tone from the Fed has taken some steam out of the dollar's rise. Mr. Powell's cautious comments suggest he's taking notice of the impact that higher US interest rates are having on emerging markets, where of course a higher dollar makes it harder to finance borrowings denominated in the US currency. The Fed is not obliged to care what goes on in the rest of the world outside the US, but it does need to watch developments carefully because of the increasing linkages between all countries in a globalized economy. Second, they suggest that the Fed is keeping an eye on what's called in market jargon the yield curve. This sounds a bit obscure and technical, but all it measures is the relationship between the yields on short-dated bonds and longer-dated ones. Normally, longer-dated bonds yield more than short ones to compensate investors for inflation and for default risk. But occasionally this relationship shifts and long bonds yield less than short ones. When this happens, it's usually because investors are worried that the Federal Reserve, or any central bank for that matter, is tightening too fast and will have to change course in the near future when the economy duly turns lower as borrowing costs rise. We're close to that inversion today. Both 2-year bonds and 10 years yield about the same as each other. And the Fed is keeping a close eye on the message from the market. Crucially, an inversion of the yield curve has in the past preceded a recession and a bear market for stocks. And this is why investors always keep a firm eye on this key market measure. The third reason to expect the Fed to tread carefully from here is the fact that US economic data is just starting to disappoint against admittedly high expectations. There's less evidence, for example, that inflation is a worry for the Fed. Hence, Mr. Powell's cautious comments laced with plenty of ifs and buts. The market loved what he had to say. It suggests that expectations for rate rises might be slightly ahead of themselves. In that context, it's perhaps unsurprising that the S&P 500 rose above 2,900 for the first time, while the Nasdaq index was higher than 8,000 also for the first time. Interestingly, the stocks that are driving the market rally are those that typically do well in a strong economy, cyclical sectors like financials, materials and industrials. The ones that have lagged are the defensives like utilities that investors tend to flock to when times are tough. The new records for the market also reflected some good news on the trade front. Although the relationship between the US and China remains frosty, progress was announced over the weekend with regard to Mexico. In particular, Donald Trump has been able to announce a clear America First win when it comes to car imports from south of the border. Going forward, all Mexican car imports to the US must include 75% US manufactured content, and nearly half must have been put together by workers on at least $16 an hour. That will make it increasingly difficult for big American manufacturers to shift production south to take advantage of cheap Mexican wages. The timing of the deal is no coincidence. Donald Trump now has his attention fully focused on November's midterm elections, and for good reason. With speculation rising about a bid to impeach the president for various alleged wrongdoings, he's desperate to avoid a victory for the Democrats in the House of Representatives. A simple majority of the House in favour of impeachment is all that's required to get the legal process against the president rolling. It may well remain true that a 2/3 majority in the Senate, that's the required hurdle to remove a president, remains beyond his enemy's reach, but he won't want to risk it. The Mexican deal is not the end of the trade standoff by any means. For one thing, rewriting the three-way NAFTA accord that the Mexican deal is designed to partially replace still requires Canada's cooperation. This is not guaranteed, although with an economy just 1/10 the size of the US's, Canada is arguably not in a strong bargaining position. That certainly cannot be said of China, which has much more leverage over the US and where little progress was made in talks this week. On this side of the pond, attention has focused on the government's attempts to use a set of 80 technical papers on a so-called no-deal Brexit to persuade MPs to get behind the negotiating position set out by Theresa May at the PM's country house Chequers earlier in the summer. Dominic Raab, the Brexit Secretary, is walking a tightrope by highlighting the risks of no deal. On the one hand, he wants it to sound risky enough to get everyone behind the PM's soft Brexit alternative. At the same time, he wants to send a message to Europe that everything's under control. The UK is relaxed about leaving without a deal if that's where we end up. The reality, of course, is that both